Hello. So, welcome back again to our lesson on the economics of Bitcoin mining, and this is the part two about the analysis. Now, today we're going to discuss the question that you guys probably all had. Well, not that one. I mean, halvening is the Bitcoin reward goes from 12.5 to 6.25. We know that. Well, no, that one neither. Yeah, that's the one. So what is the halvening going to do to the block reward? Or what the halvening is going to do to the Bitcoin hash rate? The halvening that the 50% is going to go down. What is this going to do to the Bitcoin hash rate? Agenda today is a little bit full. And in the notes, I'm going to give the timings of these different agenda points so that you can skip forward to the parts that you are interested in. So, point one, review session one. We quickly gonna discuss what we have previously said within session one. Agenda point two is we're looking at what one generally does with supply and demand charts. Agenda point three, we're gonna look at cost curves because cost curve is really what we're talking about here. And the point four is the one where we actually look at Bitcoin cost curve and what we can read from this one. So here we go. Review of the last session. In the last session, we were talking about the supply demand chart, which is a classic tool from microeconomics, where unit price, quantity on the two axes in a slightly funny order. Demand curve downward sloping, the higher the price, the lower the demand. The supply curve upward sloping. The higher the price, the higher the supply. The supply curve is generally for commodity also the cost curve because producers are willing to sell at marginal cost or slightly above. On the mining side, this was pretty much the same. The cost curve is really exactly the same. Hash rate is just a commodity. I mean, it's probably the ultimate commodity because the Chinese hash is the same as a US hash, is the same as a European hash. The demand curve is easier. The demand curve, the reward curve, because we know how the demand looks like. The demand is, look, we're going to consume all the hashes that we're given, and the reward, and we're paying people in proportion to what they're given. So if you're alone, you get all the reward. If 100 equal miners are there, everyone gets 100th. And if there are 100,000 miners, then everyone gets 100,000. So this the demand side is given. And here, normally when you measure hashes, you would measure the product, the unit of the product is hashes per second, but it's easier to just say, look, this is an Antminer S2 equivalent. We said so 1 terahash per second is 1 Antminer S2. 10 terahash per second is 10 Antminers S2. It just makes it slightly easier to think about those things. So classic microeconomics again, demand and supply curve meet, and we have a clearing price and a clearing quantity. This is what is going to transact it. Everyone on the left-hand side of the clearing quantity transacts, and everyone on the right-hand side does not transact. And they all transact at the clearing price. Bitcoin, exactly the same. There's a clearing hash rate being the quantity, and there is a clearing reward, which is what each miner gets in average over a long-term period. And here again, the clearing hash, the clearing hash rate separates the miners between those who operate, which are the ones in green. Why do they operate? They operate because they do have sufficient. They make money. The miners on the right-hand side do not operate because they don't make money, and there's this guy in the middle who might operate or might not because he neither makes nor loses any money. Finally, of the miners who participate, we can understand their economics. So the revenues we said are the one in this rectangle, in this pink rectangle. The aggregate cost is the surface under the cost curve, and the profit is the difference between the revenue and the cost, which means it's the area above the cost curve. All very basic. As we said, the minus on the right-hand side, they don't do anything, so we just grade them out. So this was the quick review of session 1. So now let's move on to today's new content. So first of all, we're going to do some analysis on classic microeconomics amount curves, just to get in the mood and to see how it feels. First one is we're going to look at a price shock. Price shock meaning that all costs of all producers, the costs go up by the same amount per unit. Say $1 per unit, $10 per unit or what. Here they obviously go up by quite a lot just for the sake of it. This is not drawn to scale. Normally the thing. So the blue cost curve, the lower cost curve is the initial cost curve. That in step 1 is by the cost increase is bumped up and is bumped up in parallel. So it goes up by $10 or whatever at every point along the x-axis. So what this does is that it then has a new intersect. So the old intersect, the old clearing price was the gray intersect. Once it goes up, it gets a new intersect. The new intersect is the orange intersect, which is a little bit to the left and a little bit up from where the curve was before. So the market adjustment is that the prices go up and the quantities down. Now, the interesting thing is that if you compare how much the costs went up and the prices went up, you see that the prices went up less than the cost. And there's a reason for this, and we're going to discuss the reason in the next chart. So the next chart is the demand shock. Demand shock means we're going to get one price incentive buyer, which is on the left side of the curve. So when it's on the left side, so he's willing to pay whatever he has to pay. Doesn't mean that he pays a crazy price because he still pays just the clearing price, but he's willing to pay whatever it takes. So he's all the way to the left. So the entire curve shifts to the right by a certain amount, so by a certain volume. So regardless of price, everything shifts parallel to the right. So again, this is step one. The red demand curve shifts to the right. So again, we had the gray clearing price, a gray clearing point, and the gray clearing point shifts into the orange clearing point, which means that prices go up and quantities go up. Now, again, the quantities do not go up as fast as for the whole demand of the new buyer. Why is this? Well, we look at this here. So we see again the green bar for A is the additional demand, and the green bar under B is the additional quantity. And why is it less? Well, because it's less because prices went up, and because the prices went up, some of the marginal buyers were priced out of the market. And you see this under point B. I added the dotted line of the demand that these guys under C that were priced out of the market that they had. And if you look at this, it's pretty much the total demand. The reason why it doesn't entirely fit is obviously because this is all hand drawn and things are slightly odd. But so this is why a shock always gets dampened, because to some extent some of the pain is taken by the marginal buyers who drop out. All right, so this was the first part where we looked at how does microeconomics look at supply and demand. So now let's look at cost curves a little bit more in general, because ultimately, that's really the key thing to look at, given that the demand curve is what it is. The interesting thing that we're going to analyze is the cost curve. So the first thing to understand is when the cost curve is steep, then a lot of people make really nice profits. Why? Well, everyone on the left-hand side, so the people on the right-hand side determine the price. The people on the left-hand side have low costs. So everyone on the left-hand side makes good profits. The steeper the curve, the more these profits on the left-hand side are. So this is nice. Nice profits for many, now not for everyone. The marginal person still doesn't make any profit, but a lot of people make profit. Now, if you have a steep convex curve, so then you have even nicer profits. Well, why? It's also very clear. A convex curve means that a lot of people are in this range where they have low cost. It just happens to be that suddenly the costs get much, much higher on the right-hand side. And so this is the people who drive the price are much, much fewer. And so a lot of people profit from the fact that they're the people on the other side. Of course, a concave cost curve is exactly the other way around. So this means that some people have really nice prices, but ultimately most people make relatively small profit, because then we are slowly getting to this part, which is, well, if you have a flat cost curve, then suddenly no one makes money. Yeah, the flatter the curve goes, the harder it is to make money, because, well, everyone does the same, and you make money only if compared to the other guys. So, as a reminder, steep curve means nice profits for many, steep convex curve means great profits for most, and flat curve means no profits for everyone. This is something to really keep in mind. And well, to drive this home, there is this infamous joke that really applies here, where the one of the runners says, "Look, I don't have to be going faster than the line. I only have to go faster than you." And this is really Bitcoin mining. In Bitcoin mining, the difficulty adjustment is a line. It doesn't matter how, in absolute terms, how much mining capacity it has. It simply matters how good you are, what is your position relative to your competition. The absolute terms don't matter, because the like the line simply picks up the slowest runner. The difficulty adjustment simply takes care of the differences. So another cost curve that we're going to look at, which is important, is the limited supply curve, also called the seller's market. So limited supply is, well, you have some kind of cost curve to start with, but then there is a maximum supply, and then supply simply stops. There's just no more supply in the market. And this is often relatively relevant for the Bitcoin market, in the sense that if you have a new ASIC coming out that is so much better than everything else, and there's just no point in running the other stuff, then you can essentially say, look, either you mine with the ASICs or you don't mine. And then you have a limited supply, because, well, that's the new ASICs in the market, and you either mine with those or you just don't mine at all, and that is limited supply. So the way to think about it, the way to draw the curve, is that at the maximum supply level, you do have supply, but it's at infinite cost. So if you now put the demand curve, you see that because there is the cost curve is vertical, there's a full pass through in the prices. So because there's no marginal guys who could take the hit. Every dollar changing on the demand side gives a dollar more for the profit. So that's really nice for the people who run for the producers. A slightly similar situation, or a similar situation, but not exactly the same, but this is actually really what I talked about in the Bitcoin world, is when you have legacy technology around. So you have modern technology, which has a relatively nice cost curve, and then you have a big step and you have legacy technology, that is generally mothballed. So it's somewhere in storage. It could be taken out, but it's not there. But what can happen is that once demand picks up to the point that the legacy technology becomes profitable, then this legacy technology is taken out of storage, and then the demand curve runs further. Now here we have sort of dynamics, and sorry, this chart looks a little bit complicated, but it's actually quite easy. So we're starting from the point at the bottom left, where we're still on the modern technology curve. Then our demand curve shifts slightly up to the corner. Well, what happens? Prices go slightly up, and the quantity goes up. This is when sort of all these marginal sellers come in with modern technology who weren't before in the market. But then we go into the area where there's no additional supply at this cost. So our steps B and C. Nothing happens to the quantity because the mothballed capacity doesn't appear yet. So B and C just simply increases the price levels step by step. So all the producers with modern technology make out like bandits, but otherwise not much happens. Except then when you get to the point D, where the mothball technology starts to get starts to become economically profitable, then again the quantity goes up, and then you see that the price increases a little bit less because the quantity goes up. Okay, so this was as much as I wanted to talk about the legacy stuff, and now we're getting into the really interesting thing is we're gonna look at Bitcoin mining reward cost charts. So now we're looking at actual Bitcoin mining. The first thing is we looked at idealized cost curves all the time. Now I want to look at how a real Bitcoin cost curve probably looks. And sort of from a 30,000 feet view, the curve has a number of segments. So first, on the left-hand side, the cheapest is all the stranded electricity. There are a few guys out there who essentially get electricity at zero. So this might be stranded hydro, where there's a dam somewhere that produces so much electricity that doesn't have any users of this electricity, so they can just get it for free, essentially, or free-ish. Or people who simply steal electricity. There's those as well. So it's everyone who's not paying the electricity. They are at zero marginal cost. They don't even care about their mining hardware. They just plug in whatever because they produce at zero cost. Then there's obviously a step up, and because then there's people who actually do pay for their electricity. And this is like the modern ASICs. And then on the left-hand side is the most modern ones. And then there is sort of a curve going up where either the electricity gets more expensive or where you go to the slightly less modern ASICs. But obviously, when you get 2-3 generations back, even cheap electricity doesn't help you. But it's sort of the latest and second to latest generation that probably are there. And then you get the curve getting a little bit convex at the end. So we're in this nice convex case where people make a little bit of money. Then, and there's a broken scale, there's a massive step. We get the GPU miners. And then again, broken scale, there's a massive gap, and then we get CPU miners. So that's essentially our cost curve. But obviously, that's a theoretical cost curve. Why? Because in practice, at least on the Bitcoin curve, but this might be different for other cryptocurrencies, especially if they're a bit ASIC resistant or something like this. The Bitcoin cost curve, I believe, looks like this. So you have on the left-hand side stranded hydro, where essentially you have the guys who produce at zero. Then you have the latest generation ASIC, so you have a curve, a portion of the curve which is pretty flat, where all the latest generation is with good energy prices. And then it gets convex, it gets a little bit steeper with either people who have more expensive electricity and people who have older ASICs and stuff, and so it goes up. And the reward curve somewhere cuts there. Yeah, so that's sort of where it stops. So it doesn't go to the GPU miners, and it certainly doesn't go to the CPU miners. Um, a technical point. So far, we on the y-axis we said Bitcoin per. We essentially denominated everything in Bitcoin. Um, we can do this. In this case, the reward curve is fixed, but this is nice. But then the cost curve changes with the Bitcoin price because people pay electricity not in Bitcoin, but they generally pay it in their local currency, US dollar, whatever. So you have a little bit this unintuitive thing that you have to say, oh, Bitcoin price goes up, which essentially means electricity gets cheaper. You can do this, and it's actually the clean way of doing it because, well, it also takes care of foreign exchange rates, but it's a little bit unintuitive. Alternatively, use US dollar, and this means your reward curve changes with the Bitcoin price, but your cost curve is fixed. Of course, your cost curve is fixed only to the extent that your costs are in US dollar. And because costs are not only in US dollar, you're still exposed to forex volatility, and the cost curve is going to move around left to right depending on where the FX goes and where people buy their electricity. But given that Bitcoin volatility is much bigger than forex volatility, we can say, look, if we do US dollar prices, our cost curve is more or less fixed. So going forward, we're using US dollar prices in our analysis, and we just assume that the cost curve is fixed, i.e. that everyone pays electricity in US dollar. So what happens when the Bitcoin price changes? Now, before we looked at a shift where, well, we actually looked at a shift in the cost curve and we said, look, our costs go by $10. Now here it's different. Here it's not an additive shift to the curve, but it's a multiplicative shift. So we say everything goes up by 20%. So on the left-hand side, it goes up higher than on the right-hand side. Yeah, so that is important. These yellow arrows, they have a different size. They're proportional to the height of the curve. Now, here's some data from the internet. So take it with a grain of salt. I don't know how correct it is. To see how the hash rate follows the price. And so the red line is the smoothed out hash rate. The volatile dark blue line, sorry, it's a smoothed out Bitcoin price. The dark blue line is the actual Bitcoin price, and the light blue line is the hash rate. And you see that by and large, the hash rate follows the Bitcoin price, but only in the long run. And there's especially a period there that I marked in green where really Bitcoin prices went up quite considerably, but the hash rates really came with a lag. I tried to figure out what happened there. I don't quite know what, but my guess is that this is exactly the situation that we said before. Is that like there's a limited supply of mining gear. So when the Bitcoin price goes up, remember Bitcoin price goes up, the hash rate needs to go up, but the hash rate, so which means you need more miners to deal with this. But if these miners are not being produced yet, you essentially have a supply glut, and this means that you don't follow right away. So anyway, so I was actually going a little bit advanced. So let's take a step back and let's do this more closely. So here we look at what happens when the Bitcoin price changes. So first, to set the scene, our cost curve has three segments. There is a stranded segment, there's a segment with modern hardware, and there's a segment with older hardware. So this is where the convexity starts to kick in. Now, my conjecture is that in steady state, when sort of Bitcoin has been around at the same level for a while, then some of the older hardware is in use, but not too much. And this means we're a little bit up this convex part of the curve. And this obviously means that it's very nice for the miners because this means that most of them running with newer hardware, they have a nice low cost. But the marginal miner runs the older hardware, has a higher cost. And so the mining profits overall are actually pretty nice. So now, what happens if the Bitcoin price changes and we have in this chart, we have like the central curve, and then we look at what happens if Bitcoin price goes up or what happens what Bitcoin price goes down. So what happens here? Short term, we're going to stay in the and if you stay in the region where it is relatively convex, so relatively steep. So if our curve shifts up or down, then we're going to have a high profit volatility, but because the curve is relatively steep in this part, we have a low hash rate volatility. So effectively, what happens is that if the Bitcoin price changes, this pretty much directly goes to the bottom line of the miners without them being too much impacted. Otherwise, most of them are still gonna compute. It's only a few marginal miners that decide to come in or to drop out. But in the overall picture, this is not that many of them, and they don't care that much anyway because they don't make that many profits. They're really just there for, okay, well, maybe sometimes I can make a little bit of money if price really goes up. Now, in the long term, it's a little bit more interesting. So now we're going to look at what happens when Bitcoin price goes up and people believe that Bitcoin price goes up. So the green reaction is the short-term reaction. That's the one that we just have seen. So we're going from the first intersection. So the cost curve, the cost curve to the left is the current cost curve, and the cost curve to the right is the new cost curve, but I'm going to talk about for a moment. So first thing that happens is that Bitcoin price goes up. So Bitcoin price goes up, but on the left-hand side cost curve. So that's the green arrow, essentially. So we're going from the gray intersection to the green intersection. This was the short-term reaction that we have just said, which means the profits spike, and the hash rate doesn't go up that much because, well, it's these miners, relatively high cost miners in the very steep part of the curve. However, if people think that Bitcoin prices are going to stay there, then new modern hardware is going to get in. The new modern hardware is going to shift the whole curve to the right. And because it shifts the whole curve to the right, a lot of this intersection point is going to come down again. That's the orange arrow, where the intersection comes down with the orange arrow to the orange cross. And then we say that the hash rate goes up quite considerably and the prices go down. So it's a suddenly, when we have a sudden but sustained increase in Bitcoin price, what is going to happen? Initially, the hash rate only increases slightly as the older, slightly less efficient hardware comes online, and the initial profit spikes because this is relatively expensive hardware that comes online, so the cost is pretty high. Then new hardware comes online, and this means that the hash rate goes up dramatically. When this hash rate goes up dramatically, this means the marginal miners, who remember are the very expensive miners on the old hardware, drop out, which means the prices come down. So this is when prices go up. Now, what happens if Bitcoin prices come down? And again, on a sustained basis, so people think that it's going to stay down. Or alternatively, what happens with the reward halvening, which is something that people know that is going to stay there. So that's now where we discuss it. So Bitcoin price dropping or reward halving, both do the same thing. The curve goes down on a proportional level. So where it was low, it goes a little bit. Where it was higher, it goes further. So this is the two yellow arrows that are labeled 1. Now, what happens is that some modern gear drops out. And because the modern gear drops out, the modern gear is on the less steep part of the curve. This means your profits, you have both your profits when you come from the convex part of the curve, your profits go considerably, and then when you go into the flatter part of the curve, also the hash rate goes down quite importantly. So after a sudden but sustained drop in Bitcoin price or after halvening, the curve flattens as the older, less efficient mining gear gets decommissioned. And so this means that mining profit drops considerably because the curve flattens. And even more modern mining gear might no longer be profitable if it relies on too expensive electricity. And as then the curve is already pretty flat, that this means that the hash rate can drop quite dramatically as well. So that's all for today. I hope you enjoyed it, and I hope to see you next time. And well, if you liked it, hit the subscribe and hit the like button. Bye.